What is going on, traders? Is now the time to really put your stock buying plans on hold? Should you continue to buy the dips? Should you take your finger off the trigger, that is the mouse button? In this extremely volatile market environment with ever-changing factors, updated news stories, numbers coming out left and right, it's hard to keep track of all the moving pieces, but fear not, my friends. I'm here to support you. Let's get right into it. First things first is the Fed balance sheet. Now, I talked about this in my previous video. I'm not going to go over it in detail here. However, one of the major ways in which the Fed has provided liquidity and pumped money into the economy is by buying up assets, mainly mortgage-backed securities and treasuries, and keeping those assets on their balance sheet. And every month they would keep buying more and more. Well, now they're looking to take money out of the economy because of the inflation. The way that they're going to do that is by first letting those treasuries that have upcoming maturity dates expire and not reinvest. Now, they are doing this all while hiking interest rates. The last time the Fed tried this combination of quantitative tightening was in 2018-2019, and the markets continued to tank. So much so that there was a report that Trump, who was president at the time, actually tried to fire Powell, even though it was unclear whether the president could do so or not. Because of that, the Fed stepped on the brakes and said, okay, no more quantitative tightening, no more raising interest rates. Obviously, this was pre-Corona 2020. The market shot right back up until the March 2020 COVID crash. Now, aside from that one historical case study, you would hope that the Fed actually had a little bit more confidence in what they were about to do. However, it is still a mystery. According to this article, the Fed is deploying a mystery device from its tightening toolbox today with a quote from Jerome Powell saying, "But I would just say with very wide uncertainty bands, very wide, we don't really know." He was answering a question as to how the effects of quantitative tightening will end. So that process started on June 1st, and we will see it continue month after month, and what effect it will have on inflation. We'll see what effects that will have on the bond market, because the Fed will no longer be buying large quantities of bonds, so the bond market could face a liquidity issue. Not good for the stock market. All right, if that wasn't enough, June 10th, we have the CPI data. This is the CPI data for May. If May CPI data comes in hotter than it was for April, and it is very possible, by the way, if you look at commodity prices between April and May, that will signal to the markets that what the Fed has been doing up until now is not doing anything to stop inflation, and that the Fed might even need to act more aggressively, which would then in turn bring the markets down. If by some measure of miracle, the CPI numbers are actually much less than the previous month, then you can actually expect a bear market rally or some type of violent rally in the markets. Whether that is sustainable or not will depend on a lot of other factors, some of which we will get into now. If that wasn't enough, June 15th, we have the FOMC meeting. Yes, this is the official Fed meeting where they will tell us how many basis points they're going to raise the federal funds rate. And my guess is what happens on June 10th will inform a lot of what the Fed actually does on June 15th. If inflation comes in even higher than it was last month, the Fed might actually raise by more than 50 basis points. We might get that 75 basis point rate hike. Obviously, it would be too early to tell on June 15th what the results of shrinking the balance sheet have yielded so far, because it just started on June 1st. So I don't expect to see any major changes on that front. But like I said, if the inflation data comes in way hotter than last month, we could expect a more violent Fed rate hike. Now, if that wasn't enough, we have to talk about earnings and guidance. Remember, that at the end of the day is all the stock market cares about. Can the companies in the stock market deliver on earnings, and can they provide guidance that shows future growth and future value? Now, we talked about it before on the channel, but Snap could have been the canary in the coal mine. Snap was the first major company to come out ahead of their next earnings, well ahead of their next earnings. As a matter of fact, it was shortly after they reported earnings already. And they said, guys, don't expect much. Revenue is going to keep growing. However, because of the price instability, our earnings are going to take a hit. Our income is going to take a hit. Now, you might say to yourself, well, that's Snap. Snap is not really a significant company. And you might be right. But remember, we're talking about a canary in the coal mine. That is the signal of what's to come potentially from other companies. And lo and behold, we then saw one of the biggest companies on earth, one of the handful of trillion-dollar companies, Microsoft, lowering its fourth quarter guidance, coming out ahead and saying, hey guys, we have to lower our fourth quarter guidance. And you know it's bad when one of the other trillion-dollar companies that exist on the US market Tesla also had to lower their guidance and said that they were going to cut their workforce. Another company that spent some time in the $1 trillion club, Facebook, Sheryl Sandberg, who's been the COO for so long, is stepping down. Now, there are very conflicting stories of why she's stepping down, but one of the reasons is that she does not believe in the metaverse pivot. These $1 trillion companies are so important to the indexes. If you look back in 2018, when the market actually crashed, one of the reasons was because big tech was under scrutiny. At that time, there were antitrust issues, lawsuits, etc. Now, if these companies are coming out, and we're not talking about antitrust, we're talking about them not being able to meet their guidance and having to lower their guidance, especially at a time when we look at the PE ratio. This is the Shiller PE ratio. This one actually is inflation adjusted though. When the Shiller PE ratio is still near a high and the average is around 17, well, it's not a good look that these companies, Microsoft and Tesla, are now lowering their guidance, and they're not going to be the only companies to announce this. Now, if that wasn't enough, we are looking at potentially rising energy costs. Gasoline could top $5 a gallon nationwide. I live in California. It's been well over $5 a gallon for so long. But this is not good when we're talking about metrics such as the CPI or the GDP. And more importantly, obviously, it's not good for the families that are suffering at the pumps. And this brings me to my last point of why you might want to be patient in June when it comes to buying stocks. We already had one report of negative GDP last quarter. If we get another one, this comes out on June 29th, we will officially be in a recession. It's not out of the realm of possibility that on June 29th, we get a report for the previous quarter that is negative as well because of the rising cost of commodities. So unless your favorite blue chip stock is at a bargain, like Amazon was down almost 50%, in which case I don't care what the market conditions are, I'm going to buy this regardless. There are a few others to nibble on, such as Berkshire Hathaway, Walmart, etc. But if you're looking to deploy large amounts of cash here, obviously do what thou wilt. However, in my view, I think that there is some prudence in waiting to see how June plays out. Now, we definitely could get a violent bear market rally if CPI comes in at much lower than expected, if Jerome Powell eases even more and says, yes, we're going to pause raising rates in the fall, etc. If on June 29th, we get a massively positive GDP number, those things will cause a rally. We will see the market rally because the market has been beaten up and there are investors waiting and traders waiting for an opportunity for the market to rally. We are finally starting to see sellers leave the market, and we now have an equal ratio of buyers and sellers for the first time since March 2020. So I'm going to continue buying the blue chip stocks that I think are overly beaten down and at our prices that we might not see for a very long time, but I am cautious about deploying everything into the market here. If you want access to all of our trades, long-term, short-term, options, day trades, etc., link is in the description below. We talk trades all day, every day. Would love to have you come be a part of the community. Leave a comment down below. Let me know what you think of this video. Let me know what you think of the potential of a recession. Do you think the market is going to drop some more? Are you deploying cash here or not? Are you waiting on the sidelines? Would love to hear from you. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.